All right. Good afternoon, traders. Welcome out to the Tradespoon Active Investor Workshop Series. And lo and behold, I have slides. What do you know about that? I have slides. They are ready to go. And we are talking about 3 key metrics in your trading. There's all kinds of ways to do metrics. When I first saw this, I was thinking it was more of a record keeping presentation. I was like, oh, very cool. Record keeping, right? We look at wins and losses and average win and average loss and reward to risk and expectancy. But no, this is a per trade metric. Well, what do we mean by that? Well, when we evaluate a trade, and by the way, my name is Scott Beck, and I'm going to be your host. I am the head trading coach here at Tradespoon. Maybe I should get through the housekeeping, and then we can get into the meat of the presentation. So for those of you who don't know me, that's who I am. I have been trading for over 20 years now and teaching for closer to 17 of those years. And I do need to remind you that trading, and options in particular, can involve substantial risk and may not be suitable for all investors. Please read characteristics and risks of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risks, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and or the team of Tradespoon may have a financial interest in the securities presented and the trade picks. All right. Hello again to you, Faust. Hello to everybody. Oh, wait, I still have more. Hold on. Boom. Look at that. Took me a lot of time to put that slide together, and let's discuss 3 key metrics. And then we're going to go look at some trades and just talk about how we would implement these things, right? So we are talking about number 1, return on capital. And to me, even more important and meaningful is return on risk, my R multiple. So sometimes you'll hear me say, oh, that's a 2R, that's a 3R multiple. What do I mean? So if I get into a trade and I say I'm willing to risk $300 on this trade, if I make 300, that's 1R. I've made 1 times the amount of risk, 1R. If I make $600, I'm at 2R. If I get up to 900, I've got a 3R multiple. So that's, I would like to live my life in that 2 to 3R, right? That in and of itself, that's not a return on capital. We do want to be thinking about how much are we investing and then how much return are we getting. But I'll be honest, I think return on risk is more powerful, and I actually think that it is easier to quantify before the trade. And here's why. In order for me to produce this metric, return on risk, I need to know, number 1, what is the potential for return? Therefore, what is my target? And in order for me to estimate my target, I need to have an estimated move analysis. If I'm right, how far is it going to go? And that produces return. Return on risk looks like that, right? Not through the R, but divided by. So I have return or reward over risk. So I also need to have a estimated move to the downside. So this is not just up, this is up and down. I need both. What if I'm right? What if I'm wrong? As I work with individual traders, I'll tell you right now, this is probably one of the things that is the easiest to fix. And that is just simply making sure that every time you trade, you have gone through the steps to make sure that, number 1, you have a good sense of where it's going to go if it's right. How do we do that? We'll talk about that. Number 2, how much will I let it go against me if I'm wrong? Number 3, what is my reward to risk ratio? And now I have a sense of my return on risk. Is this trade worthwhile? You'll notice that these 2 key metrics are very focused on the concept of risk without saying as much. But first thing we need to be able to do is we need to be able to define our risk. Where do I know I'm wrong? The second thing I need to do is quantify my risk. How much do I lose if I get there? The third thing I need to do is control my risk. I do that through my position sizing. And the fourth thing I need to do is justify my risk. Yeah? Define, quantify, control, justify. How do I justify my risk? With the reward. I need to know, why am I doing this trade? So I challenge everybody here today to go back and just take 3 random losing trades from your last 6 months and look to see if you accomplished those, right? If you accomplished those simple tasks, right? Which were, did you have a stop loss? Did you have a target? Did you control the amount of position you had based on how much you would lose? You do that right off the bat, you've fixed a lot of things, and you're making sure that you're quantifying and looking at the right things. Probability of success. Now that's a tougher one. We'll talk a little bit about that. That's a little bit tougher, but probability of success, we have the Tradespoon model that says, yeah, that helps us to stack some probability. Let me close this off for a second. Right, so you can kind of see the high-low probability, but that's day to day. We have our probability range trend, right? So this gives us a sense. You can see here we have JP Morgan. I'm actually going to change this to Bank of America. Bank of America and JP Morgan looked very, very similar. And you can see, right, that this starts to give us an idea of, hey, there could be a trade setting up here. It could move back up into this range. That's going to help us to stack probability, but it's not going to say you have a 65% chance of being right. The only thing that can do that is a probability model, and I'm going to just warn you right off the bat to be cautious with probability models, and I'm going to show you why. So let's talk about probability of success. And what you're going to realize is that a lot of what you're doing as you quantify your probability of success is you are looking backwards and saying, based on these rules that I'm applying, I would expect to be right 63% of the time. Why? Because I have 50 trades and I was right on 32 of them. I guess I'd have to be right 64% of the time. 32 out of 50 winners, that tells me my winning percentage, and now I start to have an idea of what's the probability when I follow this set of rules. For me, that's the most important thing. It's very, very difficult to accurately be able to look at a trade and be like, oh, there's a 68% chance. This is what people do when they do talk about probability analysis. So I'm bullish on Bank of America. I think it's pulled back. It looks like it might pop a little bit. You can see that financials have been strong. We've identified that financials is a leading segment in the market right now. So it's certainly a place that we want to look. So what would we think to ourselves? What's the probability? The problem is this. Here's a probability analysis. And what I want you to notice is that as of right now, it's 50-50. That's where we are today. How does a probability model work? This is days out. So this is expiration Friday, next Friday. That's what these hash marks are. The week after, that's the standard 19th, March 26th, April 1st, April 9th, et cetera, et cetera. And what does it say? It tells me that if I have an option until March 26th, that there is now this is one standard deviation. If you notice up here, one standard deviation. If I change that to a second standard deviation or a third standard deviation, it's going to change the probability, right? So it's going to give me up to 90% chances. But what do I know? It's still 50-50, right? It's still a 50-50 prospect. The odds of it going up to this level are the exact same of going down to this level, all the way across this chart. So when someone says that there's a 76% chance, they might be looking at this right here saying that there's a 75% chance it gets up here to 37.50, right? The problem is there's also a 75% chance it comes down to 33.36 as far as this is concerned. So what I'm saying to you is I would not use this as a metric that says I'm going to be right X% of time if I do this. This is just a random distribution of probability. Anytime any trader discusses probability, it's looking at a probability model, which again is a coin toss at any given time. Tomorrow, it's a different coin toss. At any given time, you look at where it is now, and then you look at probability going forward from there. So you do have to reassess as you go. So again, right, what I would be thinking and what I would be building towards is executing with a very specific set of rules. Written trading rules that say, here is what I start with a candidate. What makes a stock worthy as a candidate of being on your watch list? Your watch list is precious real estate. It should not just be given to anything or anyone or any stock. So first and foremost, establish some criteria that say, I'm only going to watch uptrending stocks with high liquidity, and primarily I want to find them in the top 3 or 4 sectors at any given time. I'm open to allowing strong stocks from mid-level sectors, but not strong stocks from weak sectors, right? I never want to buy the nicest house in the worst neighborhood. That's a bad decision, right? So I'm not interested in that. So that's the first thing I'm thinking to myself is my ability to identify candidates. That right there is probability stacking. We want to find group leaders, sector leaders, uptrending, high liquidity. Only trade the best stuff, right? Best of the best. There you go. Good volume, good options, tight spreads. These are the characteristics that for me say, come on in to my island of misfit toys. Next, we have now a watch list full of good stocks. What do? We watch for setups. So we want to think about, what is a setup for me? What tells me, hey, look, your horse is going to the gate. Get ready to make a bet if you think it's appropriate. So what am I looking for? Well, if I'm watching uptrending stocks, for me, it's easy. I want consolidation down. I want to see the sellers get a chance. And when they take a chance and they fail, then seller failure is a wonderful time to buy, right? To speculate bullishly. So what is my setup? What is my trigger? What says now? Now you take it. You need a trigger. When we get a trigger, then we have to have a mechanism, a process to say, here's my stop, here's my target, here's my time frame. We're going to use that to build the trade. We're going to use that to assess risk and reward, to assess, obviously, reward to risk ratio. We're going to use that to quantify the risk and figure out how much we lose if it hits that level, how much we should buy at that point. Have we justified our risk with our reward? We make sure that all of those metrics are in place. And then we pull the trigger. And then we manage the trade. And when it comes to managing the trade, you need a whole new set of rules for that. For tightening stops, for taking profits, right? All the ways that you're going to manage your trade. Ed said, any individual that played the probabilities on GME and sold the 200 strike, right, for $2.35 with 3 days left until expiration, were forced to buy that back for over 16 bucks, right? There you go. High probability options is a scary concept. There's always a cushion until there's not. And when that cushion's gone, boy, I'll tell you what, it's a struggle, right? It's a struggle. So yeah, I might be taking a different approach to some when it comes to these mechanisms here. Let me get rid of these drawings, right? So I want to be very clear about what we're trying to do with return on capital and mostly even return on risk. Return on risk means I need to know reward, I need to know risk. In order to know reward and risk, I need to know estimated moves up and down. I need to be able to quantify and create my position size based off of those structures. And probability of success comes from creating a very stable set of concrete rules. I don't want it to be ambiguous as to how I trade. I want it to be very, very deliberate. I look for the same things over and over. I pull the trigger at the same time for the same reasons. Because then when I do my record keeping and I look at after 25 trades, after 50 trades, how many went right, how many went wrong, now I have a probability, right? And I can assess that with what I was thinking. I also have an empirical, so this is turning into a little bit of a record keeping presentation. Because in order for me to assess some of this, I have to have my metrics, not just before I get into the trade, but in an ongoing basis after the trade. Because if I think it's happened to me all the time through the years. I talk about the importance of reward to risk ratio, and the people I work with are like, oh, yeah, Scott, I agree. 3-to-1, 3-to-1. Okay, then what? Then we put together a spreadsheet and keep some records, and we quantify over their last 50 trades. What's the average size win? 325. What's the average loss? 350. Wait a second. That's 0.95. That's not 300. It's nowhere near 300. So one thing that I will tell you and why metrics are so important, numbers don't lie. Numbers don't fib. Numbers don't exaggerate. Numbers don't conflate. They don't trick. Well, they can trick us. But it's very easy to trick ourselves into thinking our trading is going better than it really is. And the numbers help us say, hey, is this right? If I think I'm going to get 2-to-1 up to 3-to-1 and I should be right 50% of the time, well, I better establish that as my track record. And I better see, okay, I've got a 2.44 reward to risk ratio. I've got 52% winners over the last 50 trades. Now I've quantified that my probability of success is enough. And the most important thing about probability of success, right? The probability of success is directly proportional to return on risk. If somebody says I'm right 70% of the time, okay, and right, uh, I oftentimes say that trading's a lot like my marriage. I can either be right or I can be happy. I choose to be happy, and in trading, I can either be right or I can make money, and I choose to make money. It's not about if I'm right 70% of the time, but I'm risking two to make one. I'd much rather be right 40% of the time and risk one to make two because that's profitable, right? That is what's important. How do we see the ratios of gain on a trade? I'll show you what I do, but you've got to build those ratios, right? I mean, it starts off pretty easily. I buy a stock at 50 bucks. I set a target at 55. I have $5 of reward. I put a stop loss at 48. I have a loss of 2. What do I have? 2.5 to 1 reward to risk ratio. Looking for a 2.5 R multiple on my trade. Then I ask myself, on trades like this one, how much do I expect to be right? 50 to 55% of the time. Okay, I have all the information I need, right? So there you go, right? I like that, John. So we don't really see them other than if we make ourselves see them, right? Because once in a while you can show me the light in the strangest of places if you look at it right. Grateful Dead, you're welcome. Um, okay, so that's how we start, but then we have to build trades. If we're building options trades, I'm going to turn those stock numbers into option numbers, whether I'm buying an option or building a credit spread or some type of a spread, but I'm going to maintain focus. It doesn't matter if I buy a stock or buy an option or trade a spread. If I'm willing to risk $300, I'm willing to risk $300. It is what it is. Then I think, okay, what if I make 600 with the credit spread, but I can make 900 buying the option? Now we have something to talk about because now there is more probability. Now, as an options trader, we've added a different element of probability of success. How? With the word theta. Yeah? Theta changes probability. If I buy an option and I'm theta negative, the longer I'm in, the worse it is. Probability's working against me. If I do a credit spread, I'm theta positive. The longer I'm in, time works for me. So in that scenario of a 2-to-1 on the spread, 3-to-1 on the option, I'd be thinking to myself, well, how long is it going to take? So part of my estimated move analysis should also include time. And this is especially true if you are an options trader, but even if you're not, if you're a swing trader, time matters. These moves should happen in 5 to 9 days. If you're more of a quick position trader looking at hourly charts, 5 to 9 hours. It might be a day or two. If you're a day trader, it might be 30 to 45 minutes. We got to have an idea of how long we're going to be in and what's time going to do. So if my time is 14 days, I'm going to go with the spread. If my time is 4 days, I might go with the option. Why? Because if I know it's going to happen quickly, I know I can do better with options. Or if at least I'm expecting it to happen quickly. Right? It's an interesting realization. So when we think probability of success, we have to keep really good records so that we can look backwards and say, based on how things have gone to this point under these circumstances, this is what my expectations would be. This is what my expectations would be as far as how often I would be right, how long the trade would take, and then I have the ability to kind of put this whole puzzle together. If you know you're right 55 to 60% of the time, you might be working off 1 to 1.5 to 1 reward to risk ratios. If you know you're right between 40 and 50% of the time, you're working for 2, 2.5 to 1. If you're only right 30 to 35% of the time, you're working off of 3 to 1s, 3.5 to 1s. They've got to be there. You've got to be able to knock it big when you're right to offset your losses. Any of these systems can work. Every trader's a little different by way of what they're most interested in and what they're going to be looking at. But let's go take a look at a trade, and we'll look at basically just kind of look at these factors. This is what we need to know. Where am I right? Where am I wrong? What's my reward to risk? What's my time frame? That helps me build a trade where I'm able to define and quantify my risk, establish a position size. I know if time is working for me or against me. I know what it does to my probability of success and how it enforces me to move the the parameters of the trade. Ted said, so we can see this by using price slices on TOS. That's probably the easiest way in my book. Price slices on Thinkorswim. So you'll notice I have this probability model here, and under this probability model, I have these slices. So I'm going to come in here and let's look at Bank of America. Where am I? Okay. Okay, Bank of America. What do we know about this stock? Well, let's pull up and start getting a little bit of help here. So if we catch it down at the bottoms, I'm just going to start getting a sense of the moves. I'm going to look back as well. So we'll talk about that. But if I'm getting in at the lows now, around 34-ish, and the highs up at 38-ish, that's about a 4-point move that I would be looking for. If you notice here, 30 to a little under 30 to about 33.5. So that was actually about 4 points there. Then we moved from 33 to 37. There's about 4 points there. You can see we had one there. This one was only about 2 points, so not as much. But if you look, that's kind of what we're thinking. Do we have a 4-point move ahead of us? We'll say from 35, so that would maybe give us a target up here of 39. I maybe have a stop loss just under this low. So if I have a target at 39 from 35.5, that's $3.5 move to the upside. If I'm getting in at 34.5 and getting out at 34, might even say 34.25, that would be $1.25 to the downside. That's not what I want. Uh, 3.5 divided by 1.25, 2.8 to 1 reward to risk ratio. 2.8 to 1 reward to risk ratio. Okay, well, that looks fine. right? That looks very reasonable to us. So we'll keep going. What was the I didn't see your question, John, about BAC. Repeat that again. But I think this looks right. We have probability from the model showing us this. We have probability with the trend. Now, could I go and see what's the probability that by the 12th it's up here at 39? Well, let's go take a look. So you can see to get there in this one standard deviation, it needs about 20 something days, right? According to a probability model. What does that tell me? Not much. Quite honestly, it doesn't tell me much, right? I think that this could take, I don't think it would take 21 days. What do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9. It's about 9 days before we're like, okay, 1, 2, 3, 4, 5, 6, 7, 8, 9 days. So I need about 9 days. I don't need, I mean, 9 days is how long I'd be in this trade. That puts me to about next week, maybe the week after. So now I can start looking at this trade and establishing the parameters. I've got 39 to the upside. We'll call it 39.05. I've got 34.25 to the downside. And now I can look at building these trades. So I need at least 9 days. I'm going to I'd buy more than that. I could get 1 week extra and get these marks. This is pretty aggressive. And then here's the deal, right? Now I start quantifying reward and risk. There's reward, there's risk. And you might think, man, that looks amazing. It does. If it got to its target tomorrow, what if it takes the next day and then it keeps going? And then we get to Friday, and then it's Saturday, Sunday, Monday. And then we keep going, and we go all the way out to the possibly 15th or 16th. And you'll notice I'm now risking over 1,000 to make a little under 3,000. So what started off looking amazing definitely falls apart. The longer you're in the trade, the lower the probability of achieving your goal. Not necessarily of success, but the longer you're in, the worse it gets because the more you lose to the downside, right? So, but it meets my rules. I would consider it, sure. Or I could go out, I'd go out an extra month and maybe consider doing a spread where I might do something like this, 34 by 33. Now this trade at first glance is 2 to 1. This is this is almost the exact representation of what I was saying, right? The buy option starts off pretty good and then it starts to fade the longer you go. And if it gets through the next weekend, you could be in real trouble. This one starts at 2 to 1, and then the longer you go, the more the risk starts to drop and the gain increases, so that if we get out to next week, we're still not as good, and we'll talk about why. 224, 2.4 to 1. Yeah. What's happening? Well, for one thing, I would imagine the ball's not terrible on this. And you can see where, if you look relative to where we've been in the last year, we're very low on vol. It's only gone down to about 32.5, and we're at about 34.5 right now. So the implied volatility on this is pretty low, which means the lower the implied, and this is, again, think about how this impacts probability. The lower the volatility, the cheaper the options. So the less you pay and the less you collect if you're selling. That's going to influence how you build the trade and what your expectations are. The lower the volatility, the more I'm going to say, you know what, we're not getting as much benefit from having a spread. So what should we do? Well, we should maybe go back to looking at buying the option again. What does this tell me? There's no cookie cutter for me. There's no cookie cutter, and there doesn't need to be. And I don't think that makes trading simpler. I think that makes trading oversimplified. The cookie cutter is the approach. I always run the same searches. I always look for the same patterns in my stocks. I always look for high liquidity. I always look for a trend up. I always look for a pullback. I look to buy at or near support. That's what's going to give me a favorable reward to risk ratio. So everything that goes into the setup is cookie cutter, but how I build the trade has to be custom. Once I get my, hey, the cookie cutter says there's a cookie here, now I need to go make sure I define that cookie. Where's my stop? Where's my target? What's my time frame? How long am I going to be in there for? How close or easy is it? I need to know everything about that trade, right? And then I can make that decision to see, does this establish all of the criteria that we were looking for? So yeah, when it comes to probabilities, when it comes to expectations, for me, I want, number one, to have enough data that the data is meaningful. 25 to 30 trades, that's meaningful. 50 or more, definitely meaningful. 15 or less, you're running a risk of the law of small numbers, where you're trying to read implications into data that's just not that meaningful. So be very, very careful with that. But once I have that data, I can start to assess, based on my system, how often am I right or wrong? And what's my reward to risk ratio? Those also become metrics. These aren't just like, I hope, metrics, but we want to be working towards a certain level of metric where I know I control my loss. I know my ratio of gain size to loss size is going to contribute to my overall profitability. Right? These are the factors. These are the metrics. So it's not just the metrics, but what leads to them. What do you have to do in order to produce these metrics? You have to have everything in place. Why am I watching this stock to begin with? What type of trade would I expect this stock to produce? What would the setup look like? What would the trigger look like? Stop, target, time frame. Then we start to establish and build the trade. Then we manage the trade. And when we're done, we log the trade. And once we've logged the trade and we start to establish a certain amount of numbers that say, yeah, okay, based on my system, if I'm waiting for these setups, this is what I should expect. And there it is. Which setups are always theta positive? So at or in the money credit spread, or excuse me, at or out of the money credit spreads, at or in the money debit spreads, those are going to be theta positive. If you build more aggressive spreads, like an out of the money call spread or an in the money put spread, you're actually going to be theta positive to start the trade, and it's going to have to move in your direction before it starts to swing in your way. So that's important to notice. Butterflies and iron condors are theta positive. They're vega negative. So they're delta neutral strategies where we make money from time. That's the setup that we're looking for. Calendar spreads. I love calendars, but they're not as viable now. They're more viable when we get into a low implied volatility market, but that's a great way to get positive time decay in a low implied volatility market. So that's the main thing is in order to be theta positive, you have to sell something. And it's the selling something. If we're going to sell something, we want it to be expensive. What makes something expensive? Something with high implied volatility. That's why we watch the volatility, right? Something where this volatility spiked to 50 is going to be much more expensive than if it's down at 35. And if you sell high implied volatility, that will improve your probability of success with solid time decay. If you buy low implied volatility, that will improve your probability because it's going to give you a higher expectation of making money when it does start to move the direction forecasted. Yeah, okay, good question. Great questions. You can see that there is no right answer. There is how you build the trade, how you set stops, how you set targets. All of that goes into the way that we trade. Right now, I'm going to say again, I'm going to reiterate that I want you to be very careful about relying on a probability model, that may point you the wrong direction due to erroneous probability. If you're not, this is tougher than soccer. Nah, it's just, this is why we need to have a written plan. Right? This is, as options traders, this is what we're working towards. This is where everything is in line with the numbers, but the numbers don't lie, right? That's true. Numbers don't lie, right? So we need to see how big are our gains, how big are our losses, what's the ratio of one to the other, and how often do I see one and see the other. Then I can work on what do I need to fix in my trading to say, hey, you're losing too much when you're wrong, tighten your stops. You're not making enough when you're right, let your winners run a little better. Some of that's psychological, but we need to see if that psychology needs to change. But these key metrics, if you're evaluating them and you're forcing yourself to not trade unless they make sense, then you're going to be looking at the right things to make sure that the trade is justified and set up. So there it is. I want to open it up for questions and see. Hopefully this has resonated. Hopefully you've identified some things in your own trading that you've noticed, hey, I need to do better with this. I went with the entire concept of deliberate trading is important to me. Deliberate means on purpose. Deliberate means with careful thought and consideration. We move forward doing these things because we've established that this works over time. And we make sure that we stick to the rules, build trades the way we're supposed to build trades. We don't force, we don't accept less than we should. And that's going to change how you trade. I 100% believe that a lot of people's, what we just talked about with targets, time frames, stops, the reason and motivation behind getting in trades when we do based on what we see on a chart, the trend, the waiting for it to pull back to a support level, making sure everything's in our favor. That's what we're doing here, right? That is what we're doing to establish a consistency where we believe that our numbers make sense. Then we can tweak the numbers. right? Then we can tweak our plan to say, I need bigger wins. Great. We better have some rules that will allow us to stay in and grow them. I need some smaller losses. Great. Then let's work on techniques that get us out of trades when things start to go against us. So starting with these metrics, maintaining focus on these metrics, make sure that at any given time, you know exactly why exactly why we took the trade and exactly what our expectations from that trade would be. It's also going to help you manage the trade, because if those expectations start to fall off, if you start to notice, hey, I need to move my stop. Hey, this doesn't look like it's going to get as high as my target. Hey, how many times have you gotten in because the model or your analysis says this looks great, and then 3 days later it just hasn't done what it was supposed to, and you're like, this doesn't look as great. Okay, well, we can still give it a chance, but we're going to tighten our stop up to keep our risk down. We're going to maybe be a little bit more, or excuse me, a little less ambitious on our profit target to make it higher probability, right? If it looks like it's not moving the way we thought it was, if you're flying to California from Texas and you start running out of gas in Arizona, you're going to land the plane. You're not going to keep going. You're going to be like, hey, things have changed. Let's adapt or die. There it is. It's open for questions. We have a few extra minutes for some questions to come in. I love this stuff. If you come to the trading room, you'll notice I do all of this every time. I always have an idea of where it's going. I always have an idea of how far I let it go against me. What's my reward to risk ratio? Probability, I don't get into probability a lot. Probability over time. I'm stacking probability though by analyzing the market, by analyzing the sectors, by finding the best stocks in the best sectors, putting them on my watch list. I'm definitely trying to stack probability by what I'm looking at and when I'm looking to trade it. But these metrics I am focused on all the time. As they change, I am trying to be fluid in how I manage them. If you trade this way, I believe you will feel, number one, a much higher degree of control. And psychologically, that balance helps make sure that we trade and execute our trades better. No questions are coming in. I'm assuming that means you guys are feeling good about what we saw here today. Write it down. Write down the expectations on every trade. What has to be in place before I can go forward? Put it in order. Don't let yourself talk about how many contracts until you've looked at stop, target, time frame, and reward to risk, and then established what your risk levels will be. So there it is. How do we use theta for time? So theta is the time metric. If you look at, for example, this portfolio here, here's my thetas. This FDX trade is theta positive. It makes $3.23 a day. This one is minus 15. It loses $15 a day. That's what it is. It's just helping us understand what kind of theta we use. Ricardo says, will this work for stocks as well if we not use options? It has to work for stocks in order for it to work for options. There are some neutral strategies that I like, calendars, butterflies, quasi broken wing butterflies, that it doesn't require as much, but anything directionally traded, it has to be good on the stocks before it can be good on the options for me. I never look at the option trade without having quantified the stock trade first. The stock trade is what matters. So yes, 100% it should translate that way. How do we, okay. What are my favorite scanned details? Volume, right? 2 million shares. I'm simple. I look for things above a 200-day moving average and above a 50-day moving average. That means it's trending. I mean, once you look for something above a 200 and a 50 and with 2 million shares trading, you're only going to have maybe 700-800 stocks altogether. Then I'm going to go in and I'm going to find, the most liquid. And then I'll pull from there. I would rather find good stuff that I can watch than try to find something that's tradable right this second, right? I want to find stuff that looks good and think, hey, if I have to wait a few days for this thing to come to me, great. I'll wait a few days for it to come to me. Any other questions? Looks good. Looks good. All right. I am looking at. Do I use price action? Yes. Yeah, price action. I mean, price action turns indicators. So if you use an indicator, price has to go first, right? I can't have an oscillator turn up before price turns up. Something to consider. But yeah, I definitely want price action moving in my favor, without a doubt. So most definitely. Awesome. 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 Well, do I have a plan for a down market? Yes, I look to hedge when I'm in good markets. The more it turns into. I mean, look, this last bear market we had was ridiculous. I didn't hardly trade at all. It was just an avalanche, right? Normally, yeah, I'm going to trade the same way to the downside, without a doubt. So that is something that I would look to do. Getting killed in the market now. Well, I mean, now look what's happening, right? We had a nice run, and now we're waiting. We're waiting for things to set up. Look, you can see we've got some trades on here, making money, flat, losing money, losing some. Okay, right? We have to make sure that we understand there's times where we've got to be patient. But if you're getting killed, one thing you should think about is your position sizing too much? Is that too much risk causing you to then see things disproportionately to the downside? Or is it just simply, yeah, I don't want to lose this much when things go wrong, and that might be it. There's always information for us to have. There's always good info. So right now we should be thinking, all right, how's my risk levels? How's my number of trades? Things like that. Right? He got a little excited. We all do sometimes. Fear of missing out. Right? Psychologically, we got a lot of stuff going on upstairs, guys. That's why it's so important for us to create these rules and these routines and this structure. There's just a lot of moving parts, and I don't want to try to have to remember it all. If you've ever watched my presentation, I can hardly remember a symbol from 3 minutes ago. How am I going to manage to remember all this? That's madness to think it. So anyways, love it. Thank you for coming out and hanging out with me today, because I really enjoy doing these. I have no idea what we're going to do 2 weeks from now, but we'll be here. I'll be here. I will have slides, even if they're simple slides. Simple is better, right? Just like trading, simple is better. So evaluate what you're doing, compare it to what we've talked about, see what you can integrate, and let's really get ourselves poised for what we hope is going to be a bullish year in the market. All right, well, thank you again, guys. I appreciate it. I had a lot of fun. I hope you all enjoy the rest of your day. As always, happy trading.